A very good morning to all of you. It's great to be in Bengaluru. And the topic of discussion today, and with this August panel, is on the intersection between the private and the public market. We have a very robust startup space, which has become so important in the country over time. And the market regulator, SEBI, has really taken cognizance of that and taken many measures also to include the startup space, the new economy companies in the diversified portfolio of pool that is right now prevalent in the public market. But is the startup space ready for that? And are the investors mature enough to also understand this new economy area which is growing so fast? So exactly to discuss that, I have with me the people and the experts who have their skin in the game. Gentlemen, Ishita, lady, thanks so much for joining us on this discussion. My first question to somebody who's been investing in the startup space for a very long time and has some big short companies really in his portfolio. TCM, would you like to focus on first, how does the public market, what is the view of the startup space for the public market? How do you view it, even for your exit opportunities and for the growth capital that your portfolio companies require?
So typically when we invest in a portfolio of 20 companies, we expect 2 to 3 companies to go public as they mature after 7-8 years of our investment. And the rest of it, we end up with strategic sale. Because the whole view is that public markets, you need to have certain amount of market cap to be able to attract actually institutional capital. That means the companies that reach that scale are the ones which we believe will go public. Even then, one of the interesting conundrum that today both investors, private market investors, there's a lot of money that is sitting in private markets, not only in India, globally. And you will see that in the past, typically even in US, companies will go public in 6 to 7 years, like if you see LinkedIn and Google and all which have done. But later, if you see, they've all taken 10 years or more to go public, because they've remained in private for a few reasons. One is private market, there's a lot of money that's coming in. So founders and investors feel that in a public market, the CEO is forced to operate with a quarterly target which he has to meet. Otherwise, there's an analyst who is going to say that it's an outperform or underperform, and that's going to affect the stock price. So they are becoming extremely short-term oriented instead of actually what is right in the long term for the company to create value. So this is one of the challenges that people face. And so with larger and larger pools of capital available in private markets, the exit opportunities, IPOs are getting pushed out. That's one. You can see that in Uber, you can see that in many other companies. The second is also in public markets, especially in India and not in outside. Going public requires actually being profitable, and profitable for 4 to 6 quarters. And with predictability being available for, let's say, at least for the next 2 years, in terms of that you are not going to have any vagaries, right? And the companies are growing at a certain pace. And typically when, let's say, in public market expectation, large institutional investors in public market expect actually a growth in 15 to 20% in top line and possibly 25 to 30% in bottom line. That's considered a great company. And if you now look at, let's say, in NSE, there are not more than maybe 50 companies which will meet this criteria. That is where a lot of money that goes behind and not the others. Whereas the companies that, that remain private, actually they grow at a much faster pace. Typically they grow between 40 to 100% annually, even at a very large scale, right? So, and that's, while they do that, they are actually investing in future growth, and that remains in loss. If the same companies choose to grow at, let's say, 20 to 30%, they actually can become profitable. So the conundrum is, should I actually compromise my growth to go public? That's the second one. And these are two major issues.
All right. So well put. And TCM, I'll come back to you for more on that. But two important aspects which are probably restrictive for the startup space to make way into the public market. Ishita, bringing you in this conversation. Now, recently, SEBI has notified the new guidelines which have given many dispensations, made it extremely flexible for the startup space to migrate into the main platform. What are the benefits that come to the startup space with this? Because TCM spoke about some of the restrictions, but I'm sure there are many benefits that come with it, which can really attract these new technology-based companies to make way into the public market.
Thanks, Nisha, and hello, Bangalore. I think for a large part, this conversation is really about how do we get Bangalore to Mumbai, right? For some of us who come here from Mumbai, it's almost like a move from a public market to a private market. We come from the world of traders, brokers, investors, Nifty, and we come here and we hear words like startups, incubators, Ps, and VCs. So I think this entire dialogue is really about how do we take some of you to Mumbai and create a gateway for you. And I'll be coming back to how we are addressing that, but about 2 years back, we had led a discussion here in Bangalore, where we spoke to a group of about 90 mature late-stage startups and asked them that, what are you thinking? How many of you or how many of the people you know in your ecosystem have accessed the public markets? At that time, the answer was only 2. And those 2 people were the people we had invited to share their experiences about going public. Then we asked them that how many of you want to go public in the next 1 year? Nobody raised their hand. And then we asked them how many of you want to access the public markets in the next 2 to 3 years? And almost 40% of that room raised their hands. Today it's been 2 years and we haven't seen any one of them access the public markets. So I think we have delved around the issue of what has held some of you back. Let me just flip this around and tell you what are you missing out on by not accessing the public markets? To start with, and this is against the narrative that Mr. Pai was talking about, that we want to make everybody a billionaire. Getting listed is not just about liquidity or exiting or valuation unlocking. It's actually a very potent source of fundraising. It's not just about a milestone which you achieve when you reach a certain stage in your growth trajectory, where you feel that, yes, I'm now profitable, I'm predictable, people will now understand me, people will be able to value me. No, it's not that. It's about going and tapping the market for raising funding for your own growth. And there are enough examples. If you look at what has happened, and I don't like giving the US and China example anymore, we are our own market. But still, if you really look at the evolution of the way a lot of these startups have come up, a majority of, a lot of them, if you really go back in time to early 2000s and maybe mid 2000 up until 2013-14, public capital was one of the most key sources of fundraising for these startups. So if you look at somebody like a Netflix, right, they tapped the markets way back when they were valued at southwards of $500 million. And they came to market as a video renting company. And today, look where they are. I mean, they are almost a $160 billion company. Likewise for Amazon, which came to market way back as a company that used to sell books online. And at that time, I remember in their prospectus, they made a statement that we would capture X percentage of the total book sales in the world. And today, they are almost $1 trillion company. So the thing is that it's not that these companies had everything figured out when they came to the markets, right? They came where they were, wherever they were, and they evolved in the markets. And that's what happens. It's the same thing that happens in the private markets also. Some people evolve and they are successes, and some people are not able to evolve and stay ahead and able to create a long-term value. They have to they die down. And we've had about 14, 15 companies that have accessed from your ecosystem that have come to the market. Some of them are doing fantabulously well, and some of them are actually slowing down their growth. And it's not because the market, when they debuted, held them back. They fantabulously debuted in the market. But after a while, they kind of sank down. So
Salil has been working on many such transactions. Salil, Ishita was mentioning about some of the companies really getting astronomical returns and doing well. It has been a positive commentary. What has your experience been in this space, and what are the various drivers or factors which cause for the success of some of the companies which list on public markets?
So I think, Nisha, I'd like to answer this question keeping in mind addressing one particular myth which is there in the public markets about public markets, that loss-making companies cannot go public, or companies. So that if you just go back in history, and I mean I've followed a few sectors for about 15-20 years now. Take big sectors in India, telecom. When telecom went public in the early 2000s, Bharti, which was eminently loss-making. Markets accepted it. People created big value out of that. Retail in India, Future, when it listed, was loss-making, accepted it. DTH business in India, we took Dish TV public. At that particular point of time, it was at a stage where people did not even see any visibility on profitability. However, it still got accepted and created value for some of the shareholders. We took radio public at a time when it was a loss-making business. Even the industry was loss-making. It went public. So actually markets do, in the Indian context, public markets are open to accepting businesses which are not profitable, but they accept them only when they get a sense that there's a visibility of profitability. There's a path to profitability that people can expect. The metrics that the investors look at when they value such companies are not necessarily eyeballs based or revenue multiples based and so on. The metrics that people really look at is that, can I see the business model succeed over the next 3, 5, 7 years? When it succeeds over the next 3, 5, and 7 years, what is the size of the profitability that business can generate? And when it generates that kind of level and the growths taper off, they taper off from the 40, 50, 60% that TCM was talking about to the 20%. But at that stage, what are the exit multiples that markets pay for those businesses? And then discount that back to get a value today. Right. Multiple times such situations happen. We had Mohandas Pai talking a little while back, and and phenomenal value that's got created by an Infi. But the P multiple for an Infosys in year 2000 was 120 PE. And an investor who put money in Infosys in the year 2000 also has made tons of money. And it was the same public market investor who's put that in. So the real takeaway is that markets are willing to experiment. Public markets are willing to experiment as long as they can see that they can, look at, valuations from the prism that they're used to see. I'll be giving some,
That's a very valid point, Salil, because the feedback that I have also received is that for any differentiated product, and I would say that tech startups are a differentiated product, like even probably a REIT or an InvIT was, or many others, probably a new set of shareholders or the shareholders with a different kind of mindset are required. So probably Sudhir can throw more light on that, about the ecosystem that needs to also develop and also assimilate these kind of products coming in and have the right understanding with the kind of restrictive areas that TCM mentioned to really invest into the startup space.
Yeah, thanks. And thanks to Let's Venture for inviting me here. It's a pleasure to seeing this whole idea of organizing India's private market. I was a participant in public markets thanks to my father's investing in it 45 years ago through an ESOP that was distributed to employees of that company. And in 45 years that I've seen equity shareholders as an asset class, as the people who play that asset, essentially are taking risk on what a business is proposing to it. So I believe there are 150 investors here and about 100 founders here. So it's a fantastic mix that we're all sitting actually in a private market in this room. As far as we as shareholders are concerned, you and I, whether we are founders of our businesses and as shareholders of those businesses, or we're just shareholders, we've neither have any founding interest in it, nor are we employees of it. So there are three sort of broad classes. When it's a private company, or it's a company which is less than 200 shareholders, yeah, that's really the legal definition. of private and public. The moment you're less than 200, it depends on what stage your business is at in terms of seeking capital from somebody outside of what I could build or my customers could give me as surpluses based on my product or service that I was giving. So I go out as a founder looking for capital because either I'm out of step in terms of being able to generate cash within my business. That's when I step out. Or there's another event that I do is I actually want to sell some of my own shares and treat myself like a shareholder and not just as a founder only. I want to make this distinction. I want to give my family some security, for example. That's the time you start looking for shareholders. And you want a shareholder who preferably understands your business, understands the business cycle it's in, understands its product, understands the service that it provides, and that understanding sometimes may not be necessarily available from any shareholder. So raw money doesn't solve for that. If it was just raw money, then that would be a completely different class of shareholders. So for example, there are many deep long-term companies on our markets and really don't get upset that there is a day trader in public markets. Because the day trader plays their role in either providing greater liquidity or discovery of price and does awesome work in terms of comparisons between this company and another company, between this industry and another industry, between this geography and that geography. I might as well bet on US markets, not on India, or bet on India, not on US. And there are so many derivatives of this shareholder universe that we sort of get caught between public and private. The legal mechanisms, the regulatory mechanisms, the shareholder pools are organized in some fashion differently between public and private markets. Their risk appetites are different. Within public markets, there are deep long players, sovereign wealth funds, large private equity funds who become public market players, large pension pools who don't mind investing for 30 years. They don't even dislodge their position. I know Infosys, when we went taking it public in '93, had a certain set of shareholders. I can tell you, even today, it's on the shareholder book. And that is a good many years later. They haven't changed the position. So for me, either the founders or investors, just understand when we use the word private market, you're basically going to sit in a smaller pool of shareholders. You might need to exercise your mind differently. It's not profit, it's not loss, it's not which industry, it's not differentiated products. I could be selling tea, but I could be doing it in a private market, and I could call myself Chai Point. Maybe I want to change the status quo of how I sell chai. I might set up a live space, and I say I want to set up just carpentry, but in a better manner. But I need time to build this business, to understand, a shareholder who understands it. I might then go to TCM and say, do you understand this? And he says, yes. Or I could go to my uncle, and I don't mind. He'll say, I'll give you 2 lakhs. But his wisdom will be worth 200 crores. So it's neither the amount, neither the time, neither the P&L. It's about the founders and the investors understanding why are we working, taking a similar risk quotient at that point in time.
So, Sudhir, to another question, while you're differentiating between the two markets as well, and where is the point of intersection, do you also think that while the corporate governance standards are now becoming so important for investments, being in the public market also gives a stamp of approval of some sorts?
Oh, every day when I pick up the newspaper, I find public market listed companies absolutely lacking governance. Governance lies in the people who manage these companies. It's irrelevant whether it's a public market or a private market. Governance first comes self. Then we can have imposed governance for the sake of a marketplace.
I think, Sudhir, you cannot deny the fact that public markets do have the requisite guardrails that test you so much that at least it ensures that the governance frameworks are pretty strong. Obviously, you would have people who would, maneuver or fail the system, but largely, at least 90% of what you, or 95% of what you get into is significantly cleaner, government, and meets very high standards to get in there.
Very true, but Mohan
Yes.
said the right point that
Yes.
there are no more than 50 companies where people actually trade.
True,
Because
and-
governance, there may be 5,000 listed
And
companies.
that's not because of governance.
Yeah.
That's not because of governance. That's because of their view on the growth of that company and the intrinsics. I don't think people are not trading, and the trading is skewed because they feel the governance is not there in 1,800 of those companies.
All right. So TCM, you have been investing in so many companies. Is corporate governance one of the issues that you deal with? And do you think that in private space, there can be much more flexibilities compared to a public market?
So first of all, in in my personal money, I do invest in public markets as well, right? So I know both sides of it, and what I would say is that while there are governance standards and guardrails, actually finally comes down to the intent of the board and the founders to do it. Largely, that is a check the box, right? So to that extent, those who take it seriously go beyond what is expected. That is only a few companies which do in terms of taking corporate governance seriously, like the way Infosys used to do and Wipro used to do. But if you look at it in private markets, at least when people like us invest, right, we have been able to bring corporate governance which is similar to that. In fact, in Series A, when we invest, we actually have separate audit committee and separate remuneration company, which is similar to the way public companies are there. Because we tell the founders, saying that governance doesn't come overnight. Governance doesn't come 18 months before you decide that you want to exit, whether public market or otherwise. It has to be in the DNA of the organization, which is something that we try to bring in.
All right. Apart from governance, Salil,
Nisha, I have one
jump
point.
in on this. Yes.
So I have a point on the governance part. I mean, what we've observed over the years is that public markets are very quick in reacting. So, and they reward you excellently based on performance and understanding of governance, and they punish you extraordinarily at a very quick pace, depending on perception of governance too. So you would find day in day out, and Sudhir is talking about
Right.
it. Papers littered with a lot of stuff. You can realize very quickly that any whiff of concern, there is a very diverse set of shareholders, a lot of it institutional global money, which is available, and they find significant discomfort. And when you find significant discomfort, a lot of investors just dump the stock and move.
And that's also because these markets are very liquid, right?
Yeah, they're very liquid.
I mean,
So-
if a mutual fund knows that his investor would exit if there is a challenge, and he has a day-on-day horizon, it's not a horizon which private capital pools of capital work on, where they can sit on it for 8 and 2 years and kind of.
Yeah. So
you know,
Ishita,
bring
my
it-
point really is
Yes.
that today governance standards, as TCM rightly talked about, they're inherent, inbuilt into the company, the DNA, the promoters, and the way they carry out their business. And markets give you a premium for high quality governance and give you an extraordinary discount for poor quality governance.
So Salil, while we are at it, governance is one aspect, but when you meet these startup companies, how do you make them IPO ready? What are the various aspects that they need to look at? Are they already there and you need to work on? And what are these factors?
So I think when we've had a few instances, I won't say startup companies, but relatively earlier stage companies going public. I think the first and foremost part is the business model itself. The business model, and I'll go back to the Infosys mantra on businesses. Businesses should have what they used to call PSPD. That's predictable, sustainable, profitable, and de-risked. Unless you have some of these elements built into the business model in some manner, and associated, of course, with growth, it's not easy for a wide range of public investors to easily accept such businesses. Businesses which, let's say, have potentially shorter business life cycles itself are not necessarily easy businesses to list, because the investor who's coming on board, if he has a concern to say that I don't know whether this business is going to exist after 5 years or so, I will have a problem. The moment you pass that muster, that quality business model which is here to stay, there's high growth. In India, fortunately, growth and the understanding of the growth potential is very, very high. Any investor globally or the mutual fund investor who invests in India knows that there's the enormous runway for growth in most businesses and so on. So the moment the business models
Salil,
are,
that's
yeah.
the point that ECM also made, that the startups have to decide whether they are going to go for the growth trajectory or the profitability aspect, which shareholders want in most cases in India. They are
I would think both. I mean, Nisha, it's very clear that first the business model, which is long term, two, growth in Indian context, I said, is given, but the fact that a high growth business is what most public markets investors are looking at. Investors will give you the benefit of lack of profitability in the initial period as long as there's visibility of profitability.
So profitability growth path is one of the criteria that you
That's one.
gauge from your investor interface
what
right
we
now.
what we do also, I mean, this is not applicable just to the startups, and we do it for every company that we take public, is,
But
what
most of the
TCM
companies know about it. It's the startup space which has a different way of working. So Ishita, jump in on this. From IGP to migrating into the main platforms, what is it that the companies require? What are the benefits that come with it? And how has the market regulator, given certain dispensations for the tech startup to look at this pool of capital?
So firstly, IGP, or what we call the Innovators Growth Platform, is not separate from the mains. It's a part of the mains. The only key difference is that in the mains, you have your one trading lot, one share is your one trading lot. Whereas in the IGP, you have a trading filter, which is about 2 lakhs. And which is also the way most new products, financial products in India are launched, right? Every time you launch a product, you want to make sure that you protect the retail investor till such time some precedence, trading history and coverage is established on the product. So whether you look at REITs, or you look at InvITs, or you look at anything else, there is always a trading filter that comes in, and then it gets open to the markets, which is primarily the retail investor, which the regulators want to protect at large. And that is why you have all these regulations and guardrails to protect the retail investor. Now, wherever you are and wherever you are in your trajectory, right? You are a small company, you are a medium company, or a hyper growth company, or a high alpha beta company. You can come and access the public markets, irrespective of your size, profitability, scale, anything, vintages, anything. And that's what we have seen happening in the US and China, but unfortunately has not happened in India. The IGP, which has been now curated, is a platform where we only have 2 qualifiers, right? It's a sub part of the main. One of the qualifier is that 25% of your capital needs to be held by institutional investors or accredited investors for at least 2 years before you come to the markets. And the second qualifier is that you need to be from one of the new economy sectors with intensive use of technology. Right. If you meet these 2 qualifiers, there is a market out there for you, which I think Mr. Pai has spoken about, almost about a $4 billion market month on, and I speak month on month, new capital that's getting created, which is available to access these, which is wanting to access these stocks. So, yeah, that's...
Right.
Yeah.
So TCM, what do you think right now? Do you think also the choice of shareholders that come into a company, that is also very crucial for the entrepreneurs in the startup space? So they can choose their shareholders when it comes to the private market, but in the public market, they cannot. Is that also one of the constraints, and how can that be addressed?
Yeah, so one of the way, I think, like you said, the entrepreneur wants an investor who understands the business and who's willing to take a journey with certain amount of risk that is associated with the business, right? And when you become a large company and potentially you have a path to profitability, or you are profitable, then you are able to get retail investors in. So I think IGP possibly provides a platform where more institutional investors can play in, or maybe ultra HNIs can play in. But even then, one of the key questions that will be there for existing investors would be in terms of what type of rights that they get, right? That is another important thing, and I am told that is being given consideration for, and I think that's a very important. Second thing is, there are certain businesses which that will not go public, right? So there are certain technology businesses which are built until they scale beyond a certain stage. Most likely they are likely to be acquired by either Indian corporates or Indian existing startup companies, larger startup companies, or by global acquirers. Those companies actually will become difficult to get sold fully if they are listed, right? So because India doesn't give a complete clean exit possibility where a board can recommend and all others can be asked to sell, right? So it becomes a challenge. So to that extent, those which a investor group believes that is a potential M&A candidate, irrespective of the size, is not likely to go for public listing or whether IGP or otherwise. Whereas those which are like a typical Indian consumer facing companies which are likely to be here for much longer than an investor's holding period of 5, 7 or 10 years are, are being built for actually going public. In our portfolio, we have had one
Yes.
listing that has happened, a company called Newgen which went public last January, and it's done extremely well after we sold. And in addition to that, there are 4 more which we know are potential public candidates.
In
Right.
fact, one of the trends that we've seen again in the US is that a lot of companies tend to get acquired either just before they're about to go public or within months of going public, because it kind of gives a stamp on the valuation and the governance of the company. So acquisition to that extent becomes much more easier from a value discovery perspective.
But
Right.
the acquirer wants 100%, right?
Yes.
So there in India, it is
The
not
regulations,
provided for.
yes.
So in IGP, if you make it possible, then it is okay.
Okay,
no,
that's an
uh,
important feedback. Yes.
So I'd just add on 2 points here. I mean, I kind of relate to what TCM said on the fact that if you're private, then your chance to get acquired properly is stronger because of regulatory prospects. But we've also seen the other side that, if you're listed with a great track record, and then you have an M&A situations, most of the times the value that that M&A situation gives, even from a strategic guy, people have ended up paying much premium values on the listed side too. So,
Right,
so
right.
such situation happened. I think the second point, Nisha, before I'll move on, is I think there's a very important aspect which is relevant for you all. Is theoretically there is something called promoter contribution which is required for listed companies, wherein promoters have to hold an X percentage, which is a minimum 20%, even when you go public. A lot of the early stage companies do not have situations wherein the promoter holding stays put at that higher level, and therefore that becomes an impediment to listing in India. I think the IJP platform now probably takes care of that requirement goes away. More importantly, we are also seeing the regulator in India, which is SEBI, taking a much more balanced view on this. We took a company public out of here in Bangalore, Tejas Networks, which went public, and it was identified as a company without a promoter day one. And therefore, all the requirements of promoter contribution were just done away with that company. The regulators are open to that. Of course, the construct of your shareholding and all that matters. But that as we go along, we don't see that to be as much as an impediment, which was the case.
Oh,
so
that's
far.
a very, very important point because we are going towards a corporate culture from promoter culture.
Yeah.
And these kind of regulations can
Yeah.
be.
And one more point, sorry, just to there was a company by the name Reddington, which when it went public had a promoter. Now, if you see Reddington, there is no promoter. The entire promoter holding has been sold. It's 0%. In spite of that, there is market acceptance in terms of public ownership of such a company without an identified Indian promoter. So, that's a big mindset shift in the minds of a lot of Indian public market investors too.
Right.
True. And I think it's not just limited to the promoter lock-ins and the other things that Salil has spoken about. There are a lot of things, dispensations that are actually available to you on the IGP. To start with, you just have to, unlike a regular main listing where you do your quarterlies and semi-annuals as well as the annuals, which lends to a lot of price sensitivity. This doesn't happen on the IGP. You do your semi-annual disclosures and your annual disclosures. Besides that, I think some of you, I think the bankers who've experienced going public in India way back in 2013-14, when we took a lot of these loss-making companies to the markets, there was a lot of questions about the value determination of these companies because they were not profit-making. So to that extent, you had to explain to the regulator that why are you pricing your share at a PE of about 80 times when the company is still loss-making, right? So I think that also is done away largely on the IGP because you needn't explain to the regulator what is the basis of your issue price, and how you plan to use the proceeds. If you decide you can use your entire funds towards your general corporate purposes, but that will be your volition, and it is not something that is required to be disclosed.
Right. Sudhir, what do you think about the matrices? Are they well defined in this new area of business for the correct valuation of the companies? Because we have seen in the private space, there is a very small group of investors which really takes the decision. We have seen very, very big markups at
Yeah.
very short intervals and very, very sharp markdowns as well, which cannot be done in a public market because the minority shareholders' interests also need to be protected. So when we come to the clear matrices, are they well defined, and where are we from that standpoint?
Yeah, very good point. I think, if we look at financial assets as a class, 300 trillion odd dollars around, 80% is in fixed contracts. They don't want any intangible notions. So matrices are pretty clear, even more clear than when it comes to the equity class. If you look at 60, 70 trillion dollars of market cap in equities, just 1 trillion is in private. The rest is in public. So it's interesting that the understanding of intangible valuations that are assigned to equity, which is why we invest in equity, because there's potential to really look at the intangible value of what the business does over time periods, not just the tangible P&L, balance sheet, etc. It's in the notes to accounts that a lot of matter rests. It's in the way people talk about their contingent liabilities where I think we need to think about. It's in the way you manage volatility, uncertainty in the external environment, and how are you being predictive about it. So when I say I'm an AI company and I want to do something using artificial intelligence, I'm attempting to actually change the way the status quo is of a very large conglomerate who thinks everything is predictable, everything is sustainable, everything is profitable, and everything is de-risked. However, these matrices that go and upset that whole idea or notion of PSPD is now being called private market, because the ability to think about status quo and breaking out of status quo is where these matrices start to develop. And these matrices can then need, wisdom, it needs experience, it needs gray hair, loss of hair, whatever it is, right? And then we combine that, and these matrices are not necessarily, and today it's deeply dynamic. I mean, the reason why we're discussing AI or machine learning is there are so many events that we can't even put our hands around. So we want machines to help us to deal with these events. I would believe there are a lot of technologists over here. And the way the technologists think about these matters are not the same as what I would do just because I did BCom. So matrices will develop, and public markets or private markets, frankly, are not the issue. The issue is, what do these founders and shareholders that are sitting here, 250 of us here, how do we think about issues? And then when we have alignment, you have markups and you have markdowns. So in public markets, you can get thrashed out of space if either for governance or your inability to manage VUCA or the inability to actually innovate on your product.
Right.
So we used to have a BlackBerry, we used to have a Nokia, we used to have all in the tech company space, right? Right in front of us, they do not exist. There were big, large PSPDs. So it's not about that. I don't think that's the issue. The issue really is you have to be dynamic, you have to be at the edge, you have to think about status quo. And if you're breaking out of it, most likely you should get some intangible value.
Yeah.
And that intangible value is captured actually either privately, and if you look at even public markets, it's very fascinating. In the free float area, you have very concentrated ownerships.
Yeah.
The vast majority are basically followers.
Yes.
The way the institutionalization, whether in our own market in India or elsewhere, has happened. So when I started out in public markets, we went and did IPOs to small shareholders.
Right.
We're scared of doing it today because probably I'm in the situation of caveat venditor, which is in Latin, seller beware.
Yeah.
Right? We've got to provide safety net. Don't want all that. I'd much rather have equity risk understanding with a partner who understands my risk.
Right. So after listening to all this TCM, do you think that it's only a matter of time before this space also starts dipping into the pool that public market gives? And you did mention about the exit opportunity, but above a different set of investors like private equity players use this particular space for exit opportunities beautifully. Do you think VCs will also come to that level?
Absolutely.
TCM, before you answer that, remember there's also a market that's financing putting people on Mars. So there's a value for that as well.
Yeah, I
Public
think
value.
the way we are looking at it is, if you look back 25 years, and I was sharing with Ishita 2 days ago, if you look back Sensex of 25 years and Sensex of today, there is only 7 companies out of 30 that exist today, right? You fast forward 25 more years from now, you will see at least half the Sensex being today's disruptors who are startups. That's a belief that that we have. That's why we continue investing in this startups, and we are very clear that there is more that will be coming going forward, because this is the time India has an ability to disrupt both existing incumbents in India and also global incumbents.
Your final comments, Ishita, on this. Are more robust changes and flexibilities coming in for assimilating startups in the public market?
Sure. I think Mr. Pai has definitely awakened the nationalist in a lot of us. But primarily, I think it's accessing public markets. It's beyond just getting access to funding. It's creating liquidity. It's also giving you a very strong currency for acquisitions as well as leverage, right? I think that's the point we often forget about. Getting listed or having a listed stock is a great asset to grow yourself inorganically. Facebook has done that successfully in the past, and that's something you can all explore. Leverage also. Today we have a huge dearth of capital that's coming in the form of venture debt. Banks are also now trying to match up and extend credit to some of you. But once you have a liquid stock, that becomes a huge currency to leverage your balance sheets as well. So I think, and then in turn instill a little bit more financial discipline in the way you run the business, which I think somewhere in the irrationality and perhaps the oversupply of private pools of capital is somewhere the focus is just on hyper growth rather than really the intrinsics and focusing on the financial discipline aspect of it. So I think to sum this up, we would really want some of you to consider this. Come and talk to us. We are here to give you an ecosystem. We are building an ecosystem with the bankers and investors. It's never happened before because it's never been put on the pedestal before, right? We have not had companies, we've had a handful of companies, but those have been mostly, they've been kind of, cutting across both traditional economies as well as new economies. We've not had companies that are burning so much cash to come to the markets, but I'm definitely sure that if the private markets is willing to give them value, and if somebody sitting in Canada is willing to say that, we want to buy these companies, I'm sure so would be the Indian public market investors. So I think it's something for you to explore. Whether, and then obviously some of them would be successful, just like the way your VC PE models work, and some of them are obviously not going to be successful.
So Ishita, as Mr. Pai was saying, that IPO market is all about marketing with the investors. So what you showcase to them, and if you are convincing, then you will get the right valuations as a small group of investors may also give you. So with that, I close this session. Thank you so much, all of you.